The assurances were written with precision. Economists, central bankers, and policymakers spoke in measured tones about convergence, discipline, and shared prosperity. The architecture of the single currency, they said, had been stress-tested, not just in theory, but against the lessons of Europe's own turbulent monetary past. Exchange rate instability had been removed, inflation anchored, and fiscal excess constrained by rules that seemed, at least on paper, unambiguous. What emerged was not presented as an experiment, but as a culmination, something refined, something stable. In those early years, the appearance of calm was difficult to dispute. Interest rates across member states began to align, narrowing differences that had once reflected deeply unequal economic conditions. Capital moved more freely, as if the invisible frictions that had defined earlier decades had simply dissolved. For countries on the periphery, borrowing costs fell to levels once reserved for the most stable economies in Europe. It was interpreted not as a warning, but as confirmation that the system was working. There was a sense, subtle but persistent, that a threshold had been crossed. The fragmentation that had defined European currencies, cycles of devaluation, speculative pressure, and periodic realignment, seemed to belong to an earlier chapter. The euro did not merely replace national currencies. It appeared to neutralize the forces that had once destabilized them. Markets began to treat vastly different economies, as if they were variations of the same underlying structure. What went largely unexamined was the extent to which this stability depended on assumptions that could not be tested in advance. The rules governing fiscal behavior were clear, but enforcement was not mechanical. It relied on political will, on shared interpretation, on the willingness of sovereign states to constrain themselves in ways that history had rarely sustained for long periods. The absence of immediate crisis created a quiet confidence that such discipline would hold. At the same time, structural differences between member economies did not disappear. Productivity growth, labor market flexibility, industrial composition, these remained uneven, shaped by national histories that a shared currency could not erase. Yet, the currency itself imposed a uniform monetary policy across all members, regardless of these differences. The tension between uniformity and divergence was not immediately visible, but it was present from the beginning. As capital flowed into lower-cost regions, it did not always move into sectors that would strengthen long-term competitiveness. In some cases, it reinforced existing imbalances, financing consumption or real estate expansion rather than productive investment. But these patterns were interpreted through the lens of convergence. Rising incomes, expanding credit, and increased integration were seen as evidence that disparities were narrowing. The institutional framework offered reassurance. Fiscal limits were codified, oversight mechanisms established, and the central bank given a clear mandate. Compared to earlier European arrangements, fixed exchange rate systems that had collapsed under speculative pressure, this structure appeared more robust. It was designed to remove discretion where possible, to bind member states to a shared discipline that individual currencies had struggled to maintain. Yet, the very success of this design created a particular kind of blindness. When exchange rates no longer adjust, imbalances do not disappear. They accumulate in other forms. Trade deficits persist without the corrective signal of currency depreciation. Surpluses grow without the counterweight of appreciation. The adjustment mechanisms that once operated through currency markets are displaced into slower, more politically difficult processes. None of this suggested immediate failure. On the contrary, the system functioned with a degree of smoothness that reinforced confidence. The longer it held, the more it appeared natural, even inevitable. The memory of earlier instability began to fade, replaced by the assumption that integration had solved what fragmentation could not. It is in these periods of apparent equilibrium that the deeper characteristics of a system are often set, not in crisis, but in the absence of it. The rules, the incentives, the expectations, all settle into patterns that feel durable, precisely because they have not yet been tested under strain. The euro, in its early form, carried with it the imprint of past attempts at monetary coordination. It was built to avoid their failures, to eliminate the vulnerabilities that had once led to abrupt breakdowns. But, in doing so, it also inherited a quieter set of tensions, less visible, less immediate, but no less significant. These tensions did not announce themselves. They were embedded in the structure, in the relationship between economies that shared a currency, but not a single fiscal authority, in the reliance on rules that required consistent interpretation across shifting political landscapes. They existed alongside stability, not in opposition to it. And so the system continued, appearing balanced, even as the conditions that would later define its limits were already in place. The pattern has appeared before, though rarely in identical form. Monetary unions tend to begin with a sense of alignment, often built on the belief that shared rules can substitute for deeper economic integration. The assumption is that discipline, once codified, will produce convergence over time. Differences in productivity, competitiveness, and fiscal capacity are expected to narrow as member states operate within a common framework. For a period, this expectation can appear justified. In earlier arrangements, the mechanism was often simpler. Currencies were fixed to one another, or to a dominant anchor, and central banks committed to maintaining those pegs. The stability this created was not illusory, but it depended on a continuous alignment between economic fundamentals and the fixed exchange rate. When that alignment weakened, pressure did not dissipate, it accumulated. The Latin monetary union in the 19th century offers one example. Several European countries agreed to standardize their coinage, effectively linking their monetary systems through a shared metallic standard. At first, the arrangement facilitated trade and reduced transaction costs. But differences in fiscal behavior and the management of metallic reserves gradually introduced imbalances. Some members issued more currency than their reserves could support, relying on the shared system to absorb the consequences. The union did not collapse immediately. It endured long enough to create the impression of durability. But the underlying asymmetries persisted until they could no longer be reconciled within the agreed framework. A similar dynamic unfolded in the interwar gold standard. Countries committed to fixed exchange rates anchored to gold, seeking to restore the stability that had existed before the First World War. The system required internal adjustment when imbalances emerged. Deficit countries were expected to deflate, reducing prices and wages to regain competitiveness, while surplus countries faced less immediate pressure to adjust. In practice, the burden of adjustment proved uneven and politically difficult. As economic conditions deteriorated, the rigidity of the system amplified rather than absorbed shocks. One by one, countries abandoned the standard, not because the rules were unclear, but because adherence to them became incompatible with domestic stability. These episodes share a structural feature that is easy to overlook when conditions are calm. A shared monetary framework removes certain forms of volatility, but it also constrains the ways in which economies can respond to divergence. When exchange rates are fixed or eliminated, the adjustment mechanisms shift inward. Instead of currency movements, changes must occur through prices, wages, and fiscal transfers. These processes are slower, more visible, and often more contested. In a fully integrated political system, such adjustments can be managed through centralized fiscal policy. Resources can be transferred from stronger regions to weaker ones, smoothing disparities without requiring abrupt internal changes. But in a system where fiscal authority remains largely national, this capacity is limited. Rules can constrain deficits, but they do not create a shared pool of resources large enough to offset structural imbalances. The euro operates within this tension. It provides monetary unity without complete fiscal unity, relying on coordination rather than centralization. During periods of expansion, this arrangement can appear sufficient. Capital flows toward regions with higher returns, financing growth and reinforcing the sense of convergence. But these flows are not neutral. They reflect expectations about risk and return that can shift quickly when conditions change. When confidence is high, capital tends to overlook underlying differences. Borrowing costs converge, and the distinction between stronger and weaker economies becomes less pronounced in financial markets. This was visible in the early years of the euro, when sovereign debt across member states was priced with relatively small spreads. The assumption, implicit rather than stated, was that the shared currency reduced the likelihood of divergence to a point where it no longer required significant differentiation. Yet, the absence of differentiation does not eliminate risk. It redistributes it. Imbalances can deepen beneath the surface, financed by capital that moves under the assumption of stability. Trade deficits expand in some regions, while surpluses accumulate in others. Private and public debt levels evolve in ways that reflect local conditions, even as the currency remains common. When the cycle turns, the same structure that facilitated integration begins to reveal its constraints. Capital becomes more selective, reassessing risks that had previously been discounted. Without the option of currency adjustment, economies facing pressure must rely on internal changes, reducing spending, adjusting wages, or restructuring debt. These adjustments are not only economic processes, they are social and political ones, unfolding over years rather than months. The pattern is not one of sudden collapse, but of gradual recognition. Systems built to eliminate one form of instability often reintroduce it in another, less visible form. The stability they provide is real, but it is conditional. It depends on a continuous alignment between rules, behavior, and economic conditions that cannot be permanently guaranteed. In this sense, the euro did not emerge in isolation. It followed a lineage of monetary arrangements that sought to bind diverse economies into a single framework. Each inherited not only the ambitions of its predecessors, but also the structural challenges that accompany such efforts. The breakpoints are rarely designed. They are embedded, arising from the interaction between uniform rules and uneven realities. What makes these systems appear durable is not the absence of strain, but the way strain is absorbed over time. Pressures that might once have expressed themselves quickly through currency movements or sudden policy shifts are instead dispersed across institutions, markets, and households. The surface remains steady, even as adjustments take place beneath it. In a shared currency, this process can extend for years without attracting sustained attention. Imbalances are financed rather than corrected. Deficits are rolled over, surpluses reinvested, and the continuity of the system itself becomes part of the justification for its stability. The longer it persists, the more it is assumed that its design has resolved the tensions that preceded it. But stability in such systems is not static. It is maintained through continuous accommodation. Governments adjust budgets within constraints that were not designed for every circumstance. Banks manage exposures that reflect both national conditions and shared risks. Households respond to changes in employment, credit, and prices that do not always align with the broader narrative of convergence. There are moments when this quiet adaptation becomes more visible, not as a singular event, but as a shift in perception. Confidence, which had once been distributed evenly, begins to differentiate. Investors reassess the assumptions that had allowed them to treat diverse economies as fundamentally similar. The cost of borrowing starts to reflect underlying conditions rather than shared membership alone. When this happens, the adjustment process accelerates, but it does not simplify. Without exchange rates to absorb the change, the burden falls on internal mechanisms. Governments may face rising financing costs at the same time they are required to reduce deficits. Economies may need to regain competitiveness without the tool of devaluation, relying instead on changes in wages and productivity that take time to materialize. For individuals, these adjustments are not abstract. They appear in the form of constrained public services, limited access to credit, or shifts in employment opportunities. The currency in which savings are held remains the same, but its stability no longer carries the same assurances. What had once felt uniform begins to reveal distinctions that were always present, but rarely acknowledged. Institutions, too, are drawn into this process. Central authorities are often required to act in ways that extend beyond their original mandates, responding to conditions that the initial design did not fully anticipate. These responses can stabilize the system in the short term, but they also alter its character, introducing new dependencies and expectations. What becomes clear over time is that the durability of a monetary system is not determined solely by its rules, but by its capacity to accommodate divergence without fracturing. This capacity is not fixed. It evolves with political will, economic conditions, and the willingness of member states to accept adjustments that may be unevenly distributed. The euro's stability, then, is not an illusion, but it is not absolute. It rests on a balance that must be continuously maintained, often through measures that are not immediately visible. The breakpoints are not points in time, but thresholds, conditions under which the existing framework must either adapt or confront its limits. History does not suggest that such systems fail abruptly or predictably. More often, they persist longer than expected, supported by a combination of policy intervention and collective interest in their continuation. But this persistence does not eliminate the underlying tensions. It merely postpones their resolution. In the end, what feels stable is often the result of ongoing adjustment, rather than equilibrium. The absence of visible disruption can mask the presence of structural strain, just as the continuity of a currency can obscure the differences between the economies that share it. These differences do not disappear. They accumulate, interact, and, at certain moments, become more difficult to manage within the existing framework. It is in this gradual accumulation that the inherited breakpoints of a system reveal themselves, not as sudden fractures, but as limits that emerge when the balance between unity and divergence can no longer be maintained.